But that's not the way. It's not that our workers are lazy or our people are lazy. It's that the infrastructure is not there. The automation is not there.
Yeah, absolutely.
Okay.
It's all
So
about technology.
yeah, it's about technology. It's
Yeah.
about infrastructure. Lithium deposit few years back, right? And we've never talked about that like for last, from the time of independence. This has been like this for last several years. But within that, markets being markets, so economy provides the base case, this thing, but that you are getting access to these major markets
Yeah.
at much more favorable terms than earlier. In return, of course, it's a deal is always give and take, and you can't just keep selling and not buying, right? That is because of the valuations, that is because of a lot of other factors, but not that FIS saw that Indian economy is going badly and that's why they're exiting.
Namaskar. Welcome to VRIGHT Exchange Leadership Dialogue, where markets are examined through structure, not sentiment. I am Rana Aryan Prem, founder of VRIGHT Exchange. This platform rests on a simple conviction: investors deserve clarity, not clutter. Today, we move beyond daily headlines to explore the structural forces shaping capital markets, macro transition, policy direction, global realignments, and liquidity cycles. It is a privilege to welcome back Dr. Vikas Gupta, CEO and Chief Investment Strategist, OmniScience Capital. Dr. Gupta is widely respected for his disciplined and proprietary scientific investing philosophy, institutional approach to asset allocation, integrating structural themes with evolving market cycles. Dr. Gupta, welcome back, sir.
Pleasure to be here, Rajan.
We appreciate your continued engagement with us following last week's budget conclave. At a time when equity markets are pricing in the implications of the EU India and US India trade alignments, today's dialogue will examine policy signals emerging from the Union budget, inflation and growth trajectories, RBI and Fed policy dynamics, and also earning liquidity valuations and sectoral leadership. Our guiding lens remains clear. What is structurally shifting? Where is capital positioning itself? And how should long term investors interpret this phase? So let's begin, sir.
Absolutely.
All right. So the first question to you is: how would you characterize the current equity market regime amid geopolitics, rate cycles, and showing global growth? Over to you, sir.
Thank you. So, while the global growth is slowing down, India has been, if you look at the growth rate of the GDP, the economic growth rate is the highest in across any major economy. We are actually doing more than even 7 to 8%. We are in that range. But even if I say that the projections go back around 6.8 or 7-ish in future, even then we remain the highest growth economy in the world, any major economy. Okay. Um, so if you compare, the next highest growth projections will be for China, which will be somewhere around 4 point something. And you go to any other, and we are talking real GDP growth rate here. You go to any other economy like developed economies like US or Europe, they will be much closer to 2 to 3% kind of real GDP growth rate. So we are the one and only and head and shoulders above the next in terms of growth rates. Okay. And it's not just that the GDP growth rate is high. If you see the balance sheet, the government balance sheet is strong, right? Fiscal deficits are in control. The overall economic deficits are in control. Inflation is in practically near zero. But even let's say we projected the RBI's target is around 4%, even if it is around, comes back to that, it's very much in control. So
Absolutely.
there is no major problem to the economy. Rather, everything is extremely healthy. If you look at the PMI, etc., the services PMI is above, it's nearly 58, 60. Manufacturing PMI is again in that range.
Hmm.
So both are extraordinarily high.
Absolutely.
Okay. And given this background, this has been like this for last several years. But within that, markets being markets, so economy provides the base case, this thing, but markets become extremely over optimistic at some point of time. Let's say, mid 24, it reached a kind of a peak, and now we are just coming back to that peak after nearly, one and a half, nearly slightly short of 2 years, right? So that is because of the valuations, that is because of a lot of other factors, but not that FIS saw that Indian economy is going badly and that's why they're exiting. So it is not like that. And we have consistently, the companies have also been growing, revenues have been growing, earnings have been growing, all those things are happening, uh, and that remains so.
Absolutely.
So the question you have asked is, how do you frame the situation? The situation is that fundamentally we are consistently growing. We are likely to consistently grow at one of the highest rates across the world. So companies are also doing very well. Uh, the markets have not been doing so well because of FII pullouts,
Absolutely.
and because of that, and valuations were slightly higher. So now the valuations are also come back to reasonable, and more or less we believe that the pullout is done.
All right, sir. All right. So Dr. Gupta, that's an important framing, especially your distinction between cyclical volatility and structural regime shifts. If markets are transitioning within a longer-term growth architecture rather than entering a correct contraction phase, then capital allocation discipline becomes critical. And so let's now examine how global alignments influence that regime. So my second question to you is, how meaningful are recent EU, India, and US trade developments for Indian equities and sectoral opportunities? Dr. Gupta, over to you, sir.
Yeah, so see, some people are comparing this even to the kind of 1991 reforms, the kind of trade deals we are doing, and we have had a slew of trade deals. So the most prominent, of course, is the EU and US. They are the two largest economic entities, right? And contributing more than 50-60% of global economy. So it is very important to highlight these two. But we have had, with New Zealand, we have had trade deals with Oman, and so on. So overall, what is happening is we have to look at it more on a structural and strategic point of view, from a long term point of view, that you are getting access to these major markets
Yeah,
at much more favorable terms than earlier. In return, of course, it's a deal is always give and take, and you can't just keep selling and not buying, right? So we
absolutely.
are also opening up, but we are protecting the sectors. And the reason I brought in New Zealand also is, for example, New Zealand is very, very strong in dairy. That's one of their very strong strengths. But we have protected the Indian dairy farmers in that.
Absolutely.
Okay. So same thing was then replicated in the EU deal, and same thing is being reiterated for the US as well.
Okay.
So there will be some small bits and pieces, niche things, which the Indian dairy farmers are not focused on. Those might be opened up for New Zealand, EU, US, etc. So that's the concept. It's not that you open up everything. Even in agriculture, there are kind of things which are protected, where
Absolutely.
we are strong, and there are niche things, very high end, very exotic fruits. Fine, you can bring them in, or there is some high end exotic wines, you can bring them in, right?
Yeah, yeah, yeah.
So we are opening the market in a very calibrated manner.
Absolutely, sir.
So,
Absolutely.
but we are getting access to what is called labor intensive manufacturing activities. So things
Labor.
like apparel, things like footwear, all those kind of things which require a lot of manpower. but it's not raw manpower. It is skilled manpower combined with manufacturing and engineering skills as well. Those are the kind of things we are trying to open up
Okay.
for ourselves in EU and US. And I mean, this is completely out of the blue. My guess is that we are also going to have a Indo-Japan treaty. Although I've never seen any mention of it,
All right.
but with the new prime minister in Japan,
Yeah.
I think it's very likely that we'll have a Indo-Japanese deal as well.
All right. So yeah. So that integration perspective is valuable, particularly your point that trade agreements are not isolated diplomatic events, but strategic manufacturing and supply chain multipliers. Okay. So if India is positioning itself within a China plus one or plus two, like you said, Japan and all, and rare earth realignment framework, the domestic policy layer becomes even more significant. Which brings us to the Union Budget 2026. So my next question to you is: was the budget more about short-term growth support or long-term structural signaling, and how should markets read it?
So I would, in hindsight,
Yeah,
even that time you could guess, but in hindsight, very clearly the budget was a very strategic budget. There's hardly anything for people in the short term,
yeah,
like changing of tax slabs, or we have reduced the rate. Or there's nothing of that kind,
yeah,
which used to be the full focus. If I remember, like when I was young, 30, 40 years back,
yeah,
that time people used to wait for the budget that okay, on Hawaii chappals, the interest, the tax will be reduced by 2.5%, so they will become cheaper. And on sewing machines, they're going to increase it by 5%, so that will become
yeah,
expensive.
yeah.
And the whole budget was just a laundry list of these things.
Correct, correct,
And now the budget is completely focused on, first of all, the biggest thing was all the increase was about capex,
correct.
right? And capital investments in infrastructure. And capex is what we call a gift which keeps on giving.
Yeah,
So it's not just that the year you spend it. The year you spend it, of course, it contributes to the GDP growth. But it, because now you have created a better infrastructure, it allows the rest of the economy to ride on it for next 20, 30, even 40 or more years,
yeah,
and be more productive.
yes,
Right. So I'm digressing, but it'll be very interesting for the viewers that people say that, okay, a Chinese worker is much more productive than you, a Japanese worker is more productive than you, or a US or European is more productive. So what is the popular imagination? And when I was very young, I used to also think like that.
yeah,
That when an Indian guy is putting one shovel, he's very weak, and somehow the Chinese guy is able to do triple in
yeah,
the same thing, or
yeah.
the Japanese guy is able to five times able to do.
Correct,
But,
correct, correct.
but that's not the way. It's not that our workers are lazy or our people are lazy. It's that the infrastructure is not there. The automation is not there.
Yeah, absolutely.
Okay.
It's all
So
about technology.
yeah, it's about technology. It's about infrastructure.
Yeah,
So now those things are coming in. We are seeing that we are also running fully automated plants with hardly 5, 10, 20 people running very, very large factories, right? All those things are happening in India as well. So we are on the path for that high productivity, and uh, infrastructure bottlenecks are already quite low.
absolutely.
Okay. I'm not saying that we are where we should be, but it is already so much better
Yeah.
that that's why the inflation is low.
Yes, absolutely.
Okay, because things can reach from where they are produced to where they need to be consumed very, very quickly. Earlier it would be bottlenecked.
Correct.
And so, we need something in Mumbai, it's being made in Madurai, it's not reaching us, and that's why the prices here will go up.
Absolutely.
So all those things are now going forward, they are reducing. So the focus of the budget has been and was again on this thing. Second thing, in hindsight, what I realized is lot of the proposals, like for example, the rare earth you mentioned, rare earth was not very much highlighted, but it was mentioned two, three
Correct.
times,
Acha.
right? Two, three times in the budget. One was on the Odisha side where they will have waterways to support this, and one was on all the southern states that there the mining as well as processing etc. will be encouraged. right? Through some incentives or through some initiatives. So that was highlighted. Now, when you look at the US India deal, it is this time the current thing has not mentioned rare earth,
Hmm.
but you can put two and two together.
Absolutely.
That US, EU, all are looking at the China plus one strategy because
Hmm.
China controls 90% plus of rare earth processing capabilities.
Hmm.
In India, probably has lot of things under the ground.
Correct.
Some of those things government might have discovered, might not have declared yet because it's extremely now strategic. It's like, it's sensitive to defense and security.
All right.
So everything need not. But a hint you can have that suddenly we discovered very large lithium deposit few years back, right? And we've never talked about that
Correct.
like for last, from the time of independence.
Correct.
So it's not that we didn't have or we don't have. It's being discovered, and lot of things might have been discovered but not being declared,
Declared. Yeah.
which is natural, right? It's extremely sensitive.
Absolutely.
Second measure, so rare earth was one measure. Second measure, which is very much strategic,
Hmm.
is the nuclear.
Correct.
You saw in the budget they talked about opening up the nuclear sector as well
Hmm.
for FDI, etc.
Correct.
Third strategic thing was because the whole world is now worried about AI,
Hmm. Yeah.
and AI rests on huge data centers.
Absolutely.
And we have a law that all Indian data has to be stored in India. That is basic.
Hmm.
But now in the budget, they mentioned that we are targeting data centers which will support global data.
Hmm.
So realistically, let's say we are targeting rest of Asia.
Absolutely.
Okay. Now, who is going to set up those
Yeah. Yeah.
data centers? So it was very strategic that what is happening in the future, which means rare earth,
Hmm.
artificial intelligence, data centers, we are creating, and the data centers need huge amount of power, which is where the nuclear comes in.
Correct. Correct. Correct.
So all of that is very, very strategic, interconnected, and connected to this deal making.
Hmm. Yeah, yeah, absolutely, sir, absolutely. So that means that your emphasis on viewing the budget as part of the 10, 20, 30 year structural evolution rather
Absolutely.
than a 1 year stimulus document is a powerful takeaway, sir, from your insight. Digital infrastructure, GST-led market integration, physical capex expansion. These are sequential layers. And so that the next logical question is in this environment, with what macro variable truly drives markets. So my next question to you is, with inflation moderating unevenly and GDP growth holding up above 7% and all that, what matters more for markets at this stage, sir?
Thank you. So see, what matters to market in the long run is the earnings growth rates,
Absolutely.
right? And we are seeing a lot of capex now. So far we discussed government capex, but the recent data also shows huge amount of that the corporate credit is also taken off.
Okay, okay.
And we've been discussing this for last two three couple of years, 1.5 2 years at least,
Correct.
that corporate credit we expect to be double digits, mid double digits, in the next 3 to 5 years. So we've been saying that, and now the recent data shows a 13% year on year growth
Oh,
by the private sector, right? So the private sector investment has also started kicking in,
hmm.
and now it's shown in the data as well, right, in the banks and lenders data.
Yeah.
So that's a very critical leading indicator,
Hmm.
because you are going to invest in capex because you expect higher revenues in future from that capex,
Correct.
right? So it's a leading indicator of future growth.
Hmm.
So markets are always forward looking.
Absolutely.
What the only flaw with markets, or Mr. Market, as my favorite term,
Yeah.
is sometimes he becomes over optimistic, and Mr. Market is willing to pay for next 10 years of optimistic growth.
Hmm.
And then suddenly people realize that that was too much. And that's why the market became overvalued. And then it'll bring it back and it'll become too pessimistic, become overvalued,
Hmm.
while the other pockets remain undervalued, right?
Hmm. Hmm.
Same way, even when we think headline market is undervalued, there are a lot of popular companies which remain extremely overvalued.
Absolutely, sir. So that's a announced distinction, especially the idea that market price trajectory more than absolute levels. And if growth visibility remains intact with inflation moderates within tolerance bands, which is India's inflation is within, as you said, within that range, liquidity condition become the next leveler. So, which brings us to central banks, RBI and US Fed. How do you interpret this, the current stance of RBI and also the US Fed, and what does this mean for liquidity and capital flows, sir? Over to you.
So first we'll deal with the Fed because they are the largest and they impact the global flows,
Correct.
and the RBI has to be aware of what is happening there as well.
Absolutely.
Okay. So Fed has just been announced the new chairman after Jerome Powell,
Yeah.
right, by Trump,
Yeah.
and the mandate or the selection was Trump has been saying that interest rates should be cut, etc., to drive growth, and so the new Fed chair is likely to do that. So
Okay.
two rate cuts were anyway projected
Hmm.
for 2026,
Hmm.
but it is likely that it will be slightly more
Okay.
with the new chair, right?
Okay.
So new chair it will be slightly more. Secondly, it is possible that I mean new chair will want to emphasize that look, I am very different and I have a different way of doing things. It's possible that on day one he will try to shock and create something, which means he might do a bigger rate cut than expected on day one. Right?
Hmm.
So the rate cuts could be earlier and more
Okay. Okay.
than the typical what is put in the dot plot.
Absolutely.
Okay. So that is the first thing.
Hmm.
But overall, the bias is towards the cuts.
Correct.
Then to RBI, RBI has even more leeway because our see US is still struggling with around 3%, 2.5, 3% kind of
Yeah.
inflation.
Yeah.
We are already at zero inflation.
Absolutely.
The last reported was zero inflation nearly. So that is a very comfortable situation for RBI to do things. The
Hmm.
only challenge is as soon as you cut, so inflation, you want to is allowing you to cut interest rates.
Hmm.
You want to promote growth even further,
Yeah.
but the third part, see,
Hmm.
when you do, the banks have a trilemma.
Yeah.
So they have to worry about this aspect, which is the forex.
Hmm.
And in the forex, we are finding it challenging because of the consistent outflow
Hmm.
last 1.5 years of
Hmm.
FIIs.
Hmm.
The rupee has depreciated too much.
Hmm.
Because of that rupee depreciation, along with it, you add fuel to fire,
Yeah. Yeah.
cutting interest rates,
Yeah.
then the rupee will fall even more.
Oh yes. Correct. Correct.
So this is why RBI is refraining to cut immediately. But as soon as rupee starts stabilizing,
Hmm.
likelihood is that FIs will come back
Okay.
because of the Fed rate cuts, because high liquidity in US markets,
Hmm.
and I'll will come back to why FI left also.
Hmm.
But once they start coming back, the rupee again starts appreciating to below 90,
Correct.
right? And once it stabilizes to below 90,
Hmm.
RBI will have room to cut, and
Hmm.
then they will use that to definitely cut the interest rates.
Correct. Correct. So, what is your view on FIS, sir? Why are they exiting, and what